Hi there. Welcome to the closing bell on the 24th of November. The markets, what are they doing? Well, they're just limping into the end of the year, doing nothing, very little volume, a few things about, but we just have to look at, what could be the catalyst to get this damn market out of its funk. So I'm going to show you some COT data, show you where you can find charts of the commitments of traders data. I've had a few people interested in finding out about that. So we'll have a look at some things like that because, boy, when a market has spent the whole year within the range from January, so that candle there is the month of January in the ASX, and this is the whole year spent bouncing around in that range from January. What a hellish thing to be talking about a market day in, day out when it's like this. It's not much fun. And really, you can sort of get a sense of, how I look at things, just looking at those sort of sell zones and the buy zone of that month of trading, and the midpoint sort of being a gravitational point, that midpoint there, and really just an oscillation going on, just shaking everyone out, going backwards and forwards, in between the buy zone and sell zone, through the point of control, looking good, looking bad, sucking traders in, shaking them out, sucking them in, shaking them out, sucking them back in. And right now, it's just at that point of control, isn't it? Right at the midpoint. And that's when everyone's scratching their heads, the bulls and the bears. And usually the bulls are buying up here, and usually the bears or amateurs are selling and getting short down here and dumping. So it's just been really tough. Let's have a look at the small caps, really, to get a sense of what's going on. Here's the emerging companies index, and it looks so different, doesn't it? This is this bifurcation that's going on where the top 50 stocks are holding in there, so the index looks okay, and beneath the surface, we had that crash last year, and really it's been limping along. Really, it's just constant pump and dumps. I think big shareholders just trying to get out, slowly selling stocks. So many stocks just in a real funk. And you see long-term downtrend still in place, and currently prices just above the low of the whole correction. So, really the market is not in a good place right now. It's just really constant pressure in so many areas and stocks, and just not really lifting its head. And buyers just backing off, sellers getting frustrated and hitting the bid. So boy, it's just one of those times. And you can see going back, this is going back years. It's a tough old thing trading these microcaps. But if we're looking at the buy and sell pivots as they've come out, there's a little false signal there. But it's been pretty good, haven't they? I'm just getting a sense of these waves over multiple years of how things have evolved. And really that one is not a buy pivot, because there was no sell pivot after this buy pivot. So that's really the correct one there. And also these aren't right. That's just a quirk of the programming. A real buy pivot would be, there's the lowest price in the move. So it needed to have a monthly close above that to create a buy pivot. And that hasn't happened. And now we've got a new lowest bar in the move. So it's still marching lower, and still no real sign yet that it's time to get bullish. So that'll come, and I will tell you when it's time for us to really start going for it. Right now, it's about protecting capital, having, going after things that are really interesting, like the uranium, the graphite, I think is interesting as we head towards December, and the Chinese curtailing exports there. Maybe that'll start picking up. So there's, a few things, but on the whole, you're not playing too much and you're not taking on too much risk, are you, when a market is looking like this? So let's just have a look at a few of the COT data that I tell you about sometimes. So this is a page where you can see charts of the commitment of traders' data. That data comes out on a Friday, but the data is live to the previous Tuesday, and it shows you various market participants in the futures markets and what their positioning is, long and short. So you'll have the dealers, intermediaries, the big banks, the leveraged funds, asset managers, small speculators, etc. And it can be useful when markets get very out of balance to get a sense of what's going on, and what may be fuel for a reversal and that sort of thing. So that's the site to go to, barchart.com/futures/commitment of traders. If you're interested in that, you can bookmark that and check it out every now and again. And if we have a look at a few of these, let's start with the E-mini. So this is the E-mini S&P 500, and looking at this data, obviously you see the bar chart there showing you the trading over the last few years. And down here we have the commitment of traders report, with the red line there being really the big banks, that sort of thing, swap dealers. That's the red line, so that's this one here. And then you've got the non-commercials, large speculators, managed funds, that sort of thing. And then you've got the small speculators, being those guys, the blue line. So you can see there, that's that green line, large speculators. And then on this side, commitment of traders, we've got the dealers, intermediary, asset managers, so the big money that's always sort of long, the leverage funds that can switch and do quite dramatic positioning, and other reportables, which again would be the smaller speculators and that sort of thing. So looking at that, you get a sense, don't you, of what goes on in the marketplace. You'll remember when we had the correction over a couple of years, last year, getting to that low. And then, it was very tricky at this stage, figuring out whether there was going to be a continuation down or whether it was going to try to turn up. And just interesting to see, as it was in that tricky phase through here, looking at the increasing short position by the large speculators, but the dealers, swap dealers, commercial banks, that sort of thing, were betting against them, weren't they? You've got an increasing long position there. And then once it broke out and we got the rally, you can see there was a lot of short covering going on from those large speculators. They got it wrong. And the big banks who bet against them pretty much got it right and was selling into that, lowering their position. So that was a big short covering squeeze that went on there. And then we've had this sell-off recently, all the way down here. And the interesting thing is watching this big spike that we've seen. What's been the positioning, the change in positioning on this big spike over the last few weeks? Does it have legs? And when I'm looking at this, there's not a lot going on, is there here? The asset managers aren't really loading up. the leveraged funds are actually increasing their short positioning. So that's actually they're short and they're getting shorter. So there's actually an increasing bet against the market going on here. And the dealers, the big guys, they're pretty short too. And really not covering. So when looking at that, it makes me a bit skeptical of this, that it could just turn back down pretty quick. I'm not really seeing a panicked short covering going on, which is what you would have thought would be the case. But also there's not really a big increase in longs, saying that the market is thinking things are about to blast off and that the big boys are thinking it's going to blast off. If these dealer intermediary, the big banks, are short 413 and not getting out, they're staying short and confident of their view, aren't they? So until we see things shift on that front, I guess I'm going to be a little bit skeptical of this big run and whether it's going to really carry on. I guess we've got the Santa rally idea. Maybe the S&P is just going to do something silly and then just turn straight back down. I wouldn't be surprised to see that. So yeah, that's the commitment of traders' data can be quite useful for understanding what's going on. So let's switch to the bonds. So here is the 10-year bonds, and they have been selling off, as you know, yields going up. So this is actually the price of those bonds. And boy, it's been a really rough time for bonds, and it's still near the lows, really. And what has the positioning been? Boy, look at this. The leveraged funds have a massive short position on, which they're not really covering. They're not increasing it at the moment, but their short positioning is pretty substantial. There's the 1.5 million short, and it's an outlier, isn't it? It's just been, as the trend has continued, they've just increased positioning, haven't really been covering those shorts. So that is a lot of fuel if we see news that causes bonds to really rally and yields drop. If we're nearing the end, let's say the economy really turns down, bringing forward cutting rates, whatever. There's just a lot of fuel there that could really see bonds rally quite sharply. And I was saying to you that there's a chance of a monthly buy pivot in those bonds this month, speak properly. Yeah, that's just an interesting thing to note there. The commercial swap dealers, that sort of thing, quite long and continuing to buy. The small speculators are actually now long bonds, which is interesting. And the large speculators, managed money, very short. So there's an interesting setup there, which could switch and which could really fuel the market if we do get a shift in trend in those bonds. And this is the 30-year bonds. And, interesting to note, there has been a bit of a shift in the positioning recently. The rally that we're seeing, you can see the non-commercials, large speculators have been covering shorts. And there's also been selling by the I guess, bigger commercial banks and that sort of thing. So that might be, hitting the pain threshold, time to get out of losses. But yeah, just interesting to note what is going on there in those 30-year bonds. Again, you can see here, leveraged funds are lowering their short position at the moment with this buying that's going on. So that might be the hint of things to come, of what I was saying in those 10 years. As those guys cover, it's going to create some buying pressure. And but there has been also some pretty serious selling going on there, hasn't there? From these guys who have been long and pretty much long and wrong all through here and losing money. So just interesting to note that I guess there is a shift in positioning starting in the 30 years. The 10 years hasn't really started yet. Yeah, I guess not really telling us which way it's going to break right now, but just giving you a sense of this COT data that, it can be a useful tool to check in with every now and again. And just having a quick look at gold and the COT data on that. I guess it gives you a bit of a hint at things, what's going on with the large speculators, managed money, increasing longs over this big spike that you've seen, and the commercials, gold producers, that sort of thing. They're short, as you'd be in the futures market. You're producing and then you're selling forward. They're taking the opportunity on this strength, increasing short positions on the strength. And you can see here, managed money increasing longs, having a crack, and you've got the commercials increasing their shorts here. Don't know how much that helps us with what's going on, but I guess it gives you a sense that producers and whatever using the strength to hedge and, happy near all-time highs to lower their risk. I don't know whether speculators now really starting to ramp up longs is saying, look, there are some big players thinking that gold is going to blast off through the all-time highs. My own view is that I think I've just needed a bit higher. I think it's in a danger zone right here. Looks pretty good long-term, gold. Looking like it can break out, but I'd probably like to see it holding above 2,000, 2,100. I'd almost like to see it up through all-time highs before I get too bullish right now. And that will probably depend on the bonds rallying. So anyway, today, because the markets are so dull, I just wanted to take you through the COT data, show you that site, show you how you can look at things and get a sense of what's going on. Like anything, doesn't give you the answer, but it can sometimes be useful when there's really sharp moves to give you a sense whether it's just short covering or whether the big players are really having a go. So I guess now that we've seen all that data and just finishing on that S&P, look at it, looking strong as an ox, and possibly a buy signal, not really a buy signal, but a one where I'm then very interested in saying that you can't be overly bearish. But does that COT data give us a sense that this might be a bit of a furphy? So it's very interesting. I'm amazed that with the bonds where they are, the S&P is still near all-time highs. But the fact is, most of this is the top 7 stocks that are rallying. And just like our market, beneath the surface, the general market is still actually pretty weak. So that is just the state of play at the moment. The breadth of the market is not really there. It's just a few stocks that are making the S&P look fabulous. So I guess you can take it with a grain of salt. But I probably didn't help you much today because really I'm scratching my head, wondering what's going to happen here. The ASX dead as a doornail in the middle of its range. we needed to see a breakout before I can get excited. So I guess we sit back and wait and see what comes next. All right, cheers. I'll talk with you next week.